Hello, my name is Kyle McLean, and I'm a partner and senior wealth manager here with Raymond Gorell Wealth Management. Today, we're going to be talking about maximizing the benefit of charitable deductions when giving to 501c3 designated organizations, such as faith-based, educational, or other similar entities. If you or someone you know could benefit from this strategy or the other services that our firm offers, feel free to contact our team for a complimentary consultation, where we will review your financial situation to determine opportunities for optimization from an investment, tax, estate planning, employer benefits, and retirement strategy perspective. The first critical element to understand when thinking about charitable giving is that for many, these gifts don't necessarily result in a tax deduction. Each year, taxpayers must decide between a standard deduction or itemized deductions. The standard deduction for married couples in 2025 is $30,000 and $15,000 for single filers. If your itemized deductions don't exceed the standard deduction, then your charitable giving will not reduce your tax liability. In previous years, investors could deduct the first $300 of giving, or $600 if they're married, without having to itemize. However, this is no longer allowed, making deduction maximization an important tax strategy. If you don't typically itemize your deductions, strategically timing when you make these charitable gifts, as well as certain other deductible expenses, can get you over the hump to itemize deductions in years when you otherwise might not qualify. This strategy is called deduction lumping. While it can be complex, you don't need to be a high-income individual to take advantage. To help clarify how this strategy works, let's look at an example. Robert is a single professional in Houston, Texas. His deductible expenditures include about $4,500 a year in property taxes on a small $350,000 home he inherited from his grandmother, $1,000 a year of sales taxes, and $8,000 a year that he donates to his church. Under current law, Robert's itemized deductions for state and local taxes, as well as charitable donations, are $13,500 a year, which is not enough to surpass the $15,000 threshold for the standard deduction. In essence, his itemized deductions don't change his taxes. Now let's consider how Robert can utilize deduction lumping to maximize his charitable deductions. If Robert were to pay his property taxes for 2024 in January of 2025, which is a perfectly acceptable strategy, gift his 2024 tithe to the church as a lump sum on January 1st of 2025, and make his 2025 gift to the church later in the year, as well as pay his 2025 property taxes in December of 2025, he would effectively move 2 years of deductions into a single tax year. By using this strategy, Robert's deductions look significantly different. He reaches a state and local tax deduction maximum of $10,000 for the 2025 tax year by paying both tax bills during the 2025 calendar year. He also has an additional $16,000 of charitable deductions by making his 2024 and 2025 donations in 2025's tax year. This gives him a total of $26,000 in itemized deductions, a drastic increase over the standard deduction of $15,000. Furthermore, he still received the standard deduction in 2024 despite his itemized deductions being negligible. As shown by the sum totals, the deduction lumping strategy provides an additional $22,000 of additional deductions over a 4-year period of time. Assuming a marginal tax rate of 24%, this strategy will save Robert over $5,000 in taxes owed. This example is a great way to think about the timing element of various deductions. Other itemized deductions like mortgage interest can't generally be shuffled around, but there are many that can. Another aspect to consider when making charitable gifts is making a gift of cash versus assets. In many instances, directly funding your charitable giving with cash you've already paid tax on can be a mistake. Before one can write a check or give cash, this money must be earned as income or liquidated via the sale of an asset to generate the cash given. In general, gifting the asset directly can be a much smarter move. Let's consider an example of appreciated stock within an investment account. If one purchased shares of XYZ stock at $100 and several years later the shares are worth $200, there is a $100 long-term capital gain that will be taxable upon the sale of the stock. Most taxpayers are subject to a 15% long-term capital gains tax rate, with some individuals taxed as high as 20 or 23.8% depending on income and other factors. When liquidating an asset to give the cash to your charity of choice, or simply giving cash that you've already paid a higher income tax rate on, you miss out on the tax benefit of simply donating the appreciated asset. Alternatively, when utilizing an asset gift, the investor will receive a deduction for the fair market value of the stock, and the 501c3 organization does not pay a capital gains tax. In this way, the investor receives their full deduction, and neither party ever pays the underlying capital gains tax. After covering these topics, we hope it's clear that optimizing your charitable giving can be a more complex strategy than most realize. Although it may not be the primary consideration when undertaking charitable giving, the charitable deduction associated with the giving is generally a significant benefit. It's essential to ensure your charitable giving actually reduces your tax liability when and where possible. Let's review the two key charitable strategies we've discussed today. First, for the many investors that take the standard deduction each year, charitable giving will not lower their taxes. Undertaking some strategic planning to utilize deduction lumping may help these investors itemize deductions every other year and materially reduce total taxes paid. Finally, instead of selling investment assets and donating the cash, consider donating appreciated assets directly. This avoids capital gains tax and lets you deduct the fair market value of the asset. You avoid a potentially hefty tax bill, and the charity receives the full value of the asset. At Raymond Gorell Wealth Management, we provide advice on over $1 billion in client portfolios. And as a firm, we strive to serve as an effective one-stop shop for comprehensive retirement planning. The many CFP and CPA professionals on our staff specialize in helping our clients take advantage of advanced financial strategies to materially enhance their financial ability to enjoy their lives, both before and after retirement. We invite you to schedule a complimentary consultation with our team by giving us a call, sending us an email, or visiting our website today.